Hey guys, it's Eric with Low VA Rates. Today, I am going to talk to you about why mortgage debt is better than credit card debt. And as a reminder, this is video part 3 in a 4-part series. So please pay attention. We've touched on this in previous videos, but today we're going to cover some of the reasons why the simple interest of mortgage debt is better than the complex and compounding interest of credit card debt, and even some other debts that compound and come with higher interest rates. Now, as I'm sure you can tell, it's another amazing Red Friday here at Low VA Rates. I wear red every Friday. I've invited you guys that are watching our videos every single week for years to do the same. Please join us here at Low VA Rates and thousands of others, probably millions of other people across the world wearing red in a way to show your support for the brave men and women of the military. Speaking of red, I also want you to subscribe specifically to our YouTube channel, but any other social media channels that you follow us on, follow, like, subscribe so that you're always seeing this important content that we are putting out, especially for those of you that are thinking about mortgages at this point in your life. Now, let's jump right into reason number 1 on why mortgage debt is better than credit card debt. And it's very simple. Compounding variable interest. That's nasty, okay? There's no other way to put it. Compounding variable interest. That's bad, okay? It doesn't even sound good. Credit cards usually have a variable or adjustable APR, which means the amount of interest you're being charged can change throughout the year. In addition, and that's the whole variable part, right? In addition, credit card interest also will typically compound right here daily. Every single day it's compounding. When you think of compounding, it's just stacking up. That's what I think of when I think of compounding. It's just bigger and bigger and bigger. So when interest is compounded, it means that that interest is getting added to your balance. Okay, your balance just, it's like, why is my balance growing? I haven't even charged anything. Well, because your interest is compounding and it's like drowning in quicksand. It just sucks. This new total balance also gets charged that high interest rate that we've talked about that credit cards carry. Basically, every single time it compounds, in this case, every single day, you're paying interest on previous interest that you were charged. You get my point when I say it's nasty? Get rid of credit card debt. Now, on a credit card, the only way to avoid this interest is to pay the balance in full every single month. So I want to be fair to the credit card companies out there. I use credit cards. We're talking about this. I don't even know how, that looks pretty messy, right? Like, that's my art skills. That's compounding interest. It just looks horrible. Well, you can wipe it out every single month if you pay off your balance every single month. So who cares how much compounding it is, how variable it is, how nasty it is? If you've got the ability to pay your credit card off in full, not 50% of it or most of it, pay it off in full every single month, then you're going to avoid that big mess and you can move on. But that is not most of who I'm talking to right now. Most of us carry credit card debt, okay? And that interest, as I've mentioned, is accruing very, very fast. It's stacking up. It's compounding. And it could be years before you see your balance ever start to decrease to any significant point. And that's only if you've stopped making new purchases on that credit card. If you still use the same card, you'll actually see the balance rise every single month, even while you're sitting there trying to pay it down. And that's why you see those ads, and you probably felt, just this terror and this anxiety. My credit cards are ruining me. We have a solution, and it's the VA cash out refinance. Now, in comparison, mortgage interest does not compound daily. It doesn't compound at all, matter of fact. And that's because of the way in which a mortgage amortization schedule and the fact that it's simple interest, not compounding interest. You're never, ever paying interest on interest that you've already accrued. Simple interest, okay? This is bad. I'm not going to put simple interest up there because I'm talking to you about why mortgage debt is better, and I'm going to list the reasons why credit card debt is bad. Just know this, when you make your mortgage payment every single month, you will see the balance steadily start to decrease. That's how it works. Reason number 2, interest rate percentages. We're going to get into that right now. Most credit cards carry a high interest rate. That's just how most credit cards work. On average, it is common to see credit card interest rates somewhere between 14 to 24%. I actually got a credit card ad in the mail the other day. I don't almost ever apply for credit cards through the mail. I'm a traveler. If there's this great travel credit card, maybe I will apply for it. But I started reading the fine print in preparation for some of these videos we're doing. There are credit cards right now with a 29.99% interest rate, believe it or not. Now, when you compare that to the average mortgage rates have stayed well below 10% for the last 30 years. Mortgage rates will always, based on history, be lower, and based on how the economy works, credit card rates will always be higher than mortgage rates. Now, in the last 2 years, thanks to the pandemic, if you haven't heard about COVID, I don't know where you've been, but we're just going to refer to it as the pandemic, mortgage rates have generally stayed below 3%. 3.5% is probably safer. They're low. They're below 4. They're still below 4 right now, even though we've mentioned in previous videos that they're on their way up. So I just want you to look at the difference between both of this. 4% for mortgages up to 14 to 24% for credit cards. It should be a pretty simple no-brainer as to why you should use a VA cash out in order to pay off credit card debt. Okay? You don't have to be a genius to figure that one out. I want to put the final nail in the coffin here on credit card debt versus mortgage debt. And I want to remind you that credit card debt is variable. So even if you're making all your payments on time every single month, which is a good thing to do, by the way, you've probably got good credit. You're doing that much right. The interest rate on your card can still change and go up if that's what the market is doing, which, by the way, it is right now. Mortgage rates are going to head up. Credit card rates are going to head up, and credit card rates will probably head up even faster than mortgage rates. So comparatively, if you get a fixed rate mortgage on a VA cash out loan today, and we've talked about that, it's likely higher than the interest rate you currently have. There's no shame in that. We're not hiding that. It's reality. You're going to get that 4% interest rate, just using it as an example, locked in for the entire time that you keep the loan. No matter how many times the Federal Reserve starts raising rates, you're safe. Your credit card rates will continue to increase and go up. Now, while there are plenty of other benefits to mortgage debt over credit card debt, some of these being the difference between debt for an appreciating asset versus a depreciating asset, improving your credit history and reducing stress, that's a huge one. You know, let's say you wiped out 7 different credit cards with 1 mortgage payment. Not only does all this stuff I already talked about go into play, but think of the stress that you have just been able to get off of your family's plate. The reality is, I just want you to focus on the benefits. They're easy to prove more than even actual numbers sometimes. But even the math and the actual numbers don't lie. Though we didn't actually crunch too many numbers in this video, you're definitely going to want to tune into the next video. I'm going to get deep. I'm going to go deep into the details. In the final video of this 4-part series, we're going to be doing some simple calculations to show you real-life examples of how using the VA cash out refinance to get rid of or consolidate your credit card debt can save you thousands, in many cases hundreds of thousands of dollars in interest. Thank you for watching. Please watch the 4th and final video of this series, and always wear red every single Friday. This is Eric. We'll see you next Friday at the same time.